in some of the filings. Roland, just to kick it off really quickly, particularly for new listeners, the way that I think about Innventure is a unique model which blends traditional private equity with venture capital by licensing and bringing to market technologies that have been developed by large corporations that they either have chosen not to commercialize or don't want to commercialize because it's not in their core line of business to justify it. Is that a fair characterization?
Yeah, with one important qualifier, Greg. I really like to distinguish ourselves from venture capital or private equity because we're not investors in other people's businesses. We identify promising transformative technologies that have been developed by our multinational partners and collaborators, and we build the companies around them. We run the companies we create. So we're a builder of companies, not an investor in companies.
Got it. And I think that's a really important differentiator. And I think, the first proof point is the success that you all had with PureCycle, which, isn't necessarily the cornerstone, but I think it's representative of the kinds of outcomes that we would hope to see with Innventure portfolio companies.
Yeah, that's fair. I think that's a good characterization. I mean, the important thing there is we started a company in 2015 that addressed a major unmet market need on the backs of strong, heavy IP. And in 2021, we grew it up to a $1.2 billion company when we took it public. So, that's really what we're all about. I mean, our goal is to find transformative technologies that shift the market and build industrial giants around them.
Yeah, I think it's a novel model, and I think it is an exciting model for investors. So if I just quickly recap the most recent earnings announcement, you had consolidated revenue growth of 75%. There was a dramatic reduction in G&A, down 61%. But the thing that really excited me as a large shareholder was some of the structural changes that you've made to the ethos of the company, particularly as it relates to how portfolio companies are going to be funded going forward. Because I think there was a concern, and a legitimate one from investors, that there'd be ongoing dilution to fund operations in portfolio companies. Can you talk a little bit about the quarter and talk a little bit about the implications to shareholders of these structural changes that Innventure has made at the board level?
Yeah, I mean, I think there's several changes we've made, Greg. Some of them are less about dilution. That has to do more about the independence of the board and the way we're shifting in to do that. But as you talk about the funding, anytime you have a growth company, it's universal. If you have a growth company that does not have revenue yet and you're growing or doesn't have positive cash flow, by definition you're going to dilute. The question is the magnitude of the dilution and how much you increase the value of the assets. But it was very apparent to us that it made no sense to fund our other operating companies off of the Topco balance sheet because we're not getting recognition for the value of all of those companies there. So the right place to take the dilution is to fund those companies on their balance sheet and not take any dilution at Topco to the bird in hand that we all see, which is 𝙬𝙤𝙤𝙤𝙤, because that really is the next valuation inflection point. But it's an unfair characterization to say that all of the value is in 𝙬𝙤𝙤𝙤. The other companies, Aeroflex and Refinity, have just as much potential as 𝙬𝙤𝙤𝙤𝙤, much like PureCycle did. So our job is to grow all of the businesses, but the question is, how do you fund that process? It makes more sense at this stage because we do have bird in hand with 𝙬𝙤𝙤𝙤, in our opinion anyhow, because of what's going on in high performance compute and rack densities and the need for this technology. It makes more sense to fund the other businesses on their balance sheet and to minimize the needs at Topco level at Innventure, which is why you've seen that combination of pivoting to raising on the balance sheet of Aeroflex and Refinity, and the dramatic reduction in G&A is to sort of minimize any forward dilution needed. And I think that's a very important structural change.
Well, I applaud you. Excuse me one second. Excuse me. I applaud you and the board for going down this path, and I think it really is a very shareholder-friendly strategy. What I was hoping we could do, Roland, if it's okay with you, is I'd like to talk a little bit about Excelsius and some of the recent announcements, and then have you talk a little bit about Refinity and Aeroflex and the vision that Innventure has in terms of these being potentially multi-billion-dollar standalone companies. So if you look at what was disclosed, we now know that the last round was done at $665 million for Excelsius. It included two strategic partners, Johnson Controls and Legrand, that are big players in the data center cooling space. It was announced that there's a $50 million hard booking, and that there was an analyst that asked a question about a rumor of another $25 million booking waiting in the wings. And, if you take the public statement that the goal is to exit the year at $100 million in ARR, that's pretty darn exciting. And I think you could argue that $665 million post-money valuation has probably increased in value since the time that closed. Can you talk a little bit about that?
Well, I mean, the momentum is very clear, Greg. I mean, we said that on the earnings call. We had over 50 million in bookings in Q1. That in itself is a statement, and we've certainly said we intend. Our belief is that we convert most of those bookings into revenue in this year. Now, again, we said it's probably going to be in the latter half of the year, Q3, Q4. But the important part today is we're getting real commercial commitments that we expect to convert into recognized revenue this year. And we also said we expect to be cash flow positive, which implies a run rate of 100 million. So those are important metrics, particularly for Innventure or for shareholders to be able to model. There's been some recent transactions that you can sort of model the multiples on those transactions to what does that mean for the valuation of Excelsius. I mean, the valuation of the last B round, 665 post money, that's now a historical valuation, not a forward-looking valuation.
Right. Well, one thing that has caught my attention on the valuation front is the announcement of Ecolabs acquiring Coolite for 9 times projected 2026 revenue and paying $4.7 billion for a company that exited the prior year, I believe somewhere around $150 million. So is that a reasonable comp? And that's a one-phase cooling company, if I understand it correctly.
That's correct. I mean, they have a good footprint in liquid cooling, and it's pretty clear that the industry sees that liquid cooling is necessary. They're obviously going to have to pivot towards two-phase and invest in that space because it's recognized by the industry that this is where we're going to go. And that, I think that was in the Legrand article today as well. So, but when you look at valuation...
I was just going to say, Roland, I had retweeted that article to folks interested on Twitter, and I was just wondering if you'd be willing to kind of paraphrase your takeaways from that article that seems to be a stake in the ground that the market indeed appears to be moving to two-phase cooling.
Yeah, I mean, basically what it's saying is this is no longer, an optional upgrade cooling solution. It's a critically needed cooling solution. So, I think that's really the main point there is that it's a strong validation for a couple things. Why Legrand made the investment, but certainly their view that this is an absolutely needed technology for where chips are going, and I think it's not a nice to have. It's a must have going forward for high performance compute and AI. When you look,
so is it Sorry for interrupting, Roland. Go on.
No, that's okay. Go ahead, Greg.
No, I was just going to say, and I don't know if you can opine about this at all, but it certainly seems like there's an inference that Johnson Controls and Legrand will most likely be go-to-market partners for Accelsius. Can you share anything with us about that?
Not much to share today on that, Greg, but I mean, there's some logical synergies, as we've talked about before. Johnson Control is not in the cooling of the white space or where the compute power happens. They're in the gray space. They're where your chillers are, your air handlers. So you can now offer a total solution. I think the important thing to know is that what you're going to see shortly at Data Center World is you're going to see all of them on a panel together. Which I think is going to provide a lot of clarity on just what those synergies are. The important thing to take here is they're all involved in different areas of data center infrastructure, but collectively they can provide total solutions to the data center, and that's I think the important takeaway. That's why this was a strategic investment. It's not a financial investment by JCI and Legrand. These are very, very strategic investments, and I think you'll probably learn more about that, or those that are attending Data Center World are going to hear that as they speak on a panel together.
Yeah,
and you'll probably hear more from
the implications. I think are pretty darn exciting, at least for me. Now, if it's a good point to pivot, Roland, I think that many of the people on this call are involved or interested in being involved with Innventure because of Accelsius and the massive TAM and novel technology that Accelsius has in data center cooling. And as you said earlier, it doesn't seem like Innventure's getting much credit, if any, for the potential of Refinity and Aeroflex. And I was wondering if you could spend a couple minutes talking about both of those companies and how people might think about the incremental opportunity they provide.
Yeah, I mean, I think the really what's happened here, Greg, is we saw this. This is one of the reasons we went public when we did, is we saw the massive tailwind for Accelsius. It was critically needed technology. But what's kind of gotten missed because of all the excitement around that story is that the TAMs for Aeroflex and Refinity are actually much larger. And we talked about that on the last earnings call. Refinity has a TAM, a total addressable market of about $400 billion. I mean, that's a massive market. Aeroflex is not much different. If you look at all of the verticals that they can go after, prestige beauty, industrial fluids, household items, food and beverage, shampoos, body washes. It's just massive TAMs that both of these companies have. And that's the whole point of our model, is that's the number one criteria, or the first criteria, I shouldn't say the number one, is it has to be an absolutely massive TAM, because if you look at those things, you don't have to get a lot of market share. You get 25 basis points. You get 0.25% market share of markets like that. That equates to $1 billion enterprise value. And that's what people are missing here. And what we talked about on the last earnings call is that Aeroflex has hit a major inflection point. It's signed a significant agreement in the sense that they've been able to enter prestige beauty with a global launch with Aveda commencing in 27. So Aveda has made a strong statement that it is adopting this. Now, obviously, it's not adopting it wholesale for everything. It's for their refill packs. But it's a very important starting point to enter into a marketplace. And there's a lot of fast followers. No one wants to be first, but a lot of people want to be first to be second. And we mentioned that Aeroflex has anchor customers in other sectors as well, in all sectors and geographies. We're not able to announce those names yet, unfortunately, but we have announced that we have agreements and purchase orders. And not just little purchase orders, significant multi-million-dollar unit purchase orders in one of the categories. over a couple of years. So, I mean, they are now getting commercial traction, and that's why, again, we're now able to fund Aeroflex on its balance sheet because it's hit a KPI. Last year, and this is something important, we were funding all of our businesses off of Innventure's balance sheet. You know, that is a fundamental shift when we can now pivot to a C raise in Aeroflex. You know, in Refinity, we're following the exact same playbook we did with 𝙘𝙤𝙤𝙤𝙤. With Refinity, you know, with 𝙘𝙤𝙤𝙤𝙤, we did a convert round, then we did an A round, then we did a B round, and now it's self-funding. You know, we're going to operate that same book on Refinity. And, you know, Refinity is a proven business. It's ahead of schedule. Yields are exceptional on the first kiloton or metric ton of waste that they produced. The TAM is enormous. They've got optionality for, you know, sustainable aviation fuel. Its IP position is unusually strong for a company of this size, and that goes to how we acquire our IP, by working with multinationals. So we're already acquiring IPs. We're not investing to create patentable IP. We're finding IP that's already at a very high, you know, technical readiness level. So, you know, when you look at that, you could argue that Refinity, again, you can look at very simple things. They're doing an A round. But again, you can do very simple back of the envelope heuristics. $400 billion potential market. You can make estimates of what you think their market share is going to be. That can get you to a number. You can take a look at it and say, well, what's the typical MOIC that an A round investor is going to want? And then you can calculate sort of an implied valuation of the company. But again, the point here is what Refinity is doing is something that no one has done. You're basically creating a new feedstock for petrochemical or chemical companies like Dow, BASF, and LyondellBasell. They all rely on fossil fuel feedstocks. We're creating a new feedstock, which is mixed plastic waste being converted back into the monomers that those companies need. And that has a lot of advantages. First of all, they pay a premium for those. There's a very strong sustainability need for those, but they also allow those companies to hedge against fossil fuel prices, and we've seen those prices increase dramatically this year. So to be able to have an alternate feedstock that allows you to hedge your other feedstocks is very, very important.
Indeed, fossil fuels have gone up quite a bit in the last 30 days. So one of the other things that was discussed on the call was having an investor event where each of the portfolio companies will provide an investor overview and help investors understand what the waypoints are that they should be looking for. I don't think that there's been an announcement as a date for that event. Is there anything you can share with folks about where that stands and your vision for how that ultimately unfolds?
Yeah, you'll see the formal announcement within the week, but informally, and I don't think it's going to change. It'll be April 27th at 5 p.m.
Okay. And what level, do you envision a presentation where they talk about the TAM and the technology and
it's
the
really
competitive landscape and how they envision the businesses evolving?
Yeah, it's more about where they are in execution. I mean, we all know what the companies do. I mean, sure, there'll be an overview of what everyone of them do, but really it's where are they? Where are they and where do they plan to get to? What's going on? What are they executing on? And where's the industry going? So I think it'll be very useful for shareholders to understand that, because you're going to hear it from the horse's mouth. You're going to have a much better feel for, internal dynamics within their own industries.
Got it. So I'd like to go back to the valuation topic that we just touched on. I was playing with some math before the call, and I'd like you to tell me whether or not you think I'm smoking dope or if you think my math makes sense. So if you just assumed that 𝙘𝙤𝙤𝙤𝙤 has a market cap of $1 billion, and you assume that Refinity only had a $50 million market cap and Aeroflex had a $100 million market cap, you could argue, based on Innventure's percentage ownership of those companies, that you could easily get to a share price north of $6. And then if you assume that Excelsius is next year worth $2 billion, and you just keep the 50 and 100 million for Refinity and Aeroflex respectively, you can get to a $12 share price. And if you assume that in the out years and people saw the revenue ramp and they modeled, $4+ billion in, exiting 2027, you could get to $25 a share. Is that math? Like, am I smoking dope, or how would you think about that? And I'm not asking for you to make a commitment on a share price or a price target projection, but just mathematics.
Yeah, I mean, your logic is sound, Greg. Let's put it a little bit different. I can put it a little bit differently for you. You, as I said earlier, the valuation of Excelsius, in my mind, is a historical footnote. That was the value for them to get in. And again, they're strategic investors, not financial investors. But typically, in a B round, financial investors are looking for 5 to 8 times MOICs. So that should tell you. But strategics might not want that high of a MOIC, but it tells you something, that they're investing for this thing to grow. But look at it a different way. Yes, if Excelsius is at as we said earlier, we expect it to be at in excess of 100 million run rate by the end of the year. You can apply those same types of multiples. You can apply a 10 times forward multiple to that, or the following year, and you're going to say, it's worth it's closer to $900 to $1 billion today. Another way to look at it is to say, okay, what if they hit the revenue ramp that 𝙘𝙤𝙤𝙤𝙚𝙚𝙚𝙚 at? If they get to 500 million in revenue, what's it worth? Well, 𝙘𝙤𝙤𝙚𝙚𝙚 was just acquired for $4 billion. So you're not wrong in your math there. And again, with Refinity and Aeroflex, I can characterize it again. You can use many heuristics. You can use market penetration, revenue multiples, and again, any growth multiple you can look forward. You can say they're higher. You can look at comparables, and for both Aeroflex and Refinity, if you look at, again, their TAM's 400 billion. If you just look at market penetration, you can say, okay, what if they only get 0.25% market share? Well, that implies that at some point they have $1 billion valuation. If Aeroflex is doing a C round, and investors typically are looking for a 3 to 5x multiple, you could argue that it could be worth 250 million. So these are frameworks that you can use. So, and then if we own 37% of that, that's 93 million to us. Same with Refinity. You can say, okay, they're doing an A round, so they're investors there. It's the same kind of logic, though. 400 billion, 0.25% penetration, that's $1 billion. They're doing an A round, so you're going to divide that by 10 for the MOIC that's required. You might say Refinity's 100 million today, and then we own 68% of that. Those are the types of ways in which you can design a model to get to some of your parts. But, if I do what you just did, and I said, okay, let's say $1 billion for Excelsius, and then say what I said, like if you made those same assumptions, you said, okay, Refinity's 100 and Aeroflex is 250, you'd say Innventure's around, 730 to 750 today, if you did that, if you followed that math through. But everybody has to make their own assumptions, but the data's out there for people to model this. And I think Bill said this on the earnings call, we truly do believe that we're significantly undervalued to the sum of the parts of the companies we've created, and they're all at different inflection points. Refinity has proved that its conversion process works at pilot scale, and now they're going to go and build a 10 kiloton plant. So they're scaling to that. Aeroflex is now penetrating the market. It's not that revenues are emerging. They've had 6 quarters of revenue. Their revenues are now going to be accelerating. So it squarely fits in that C space. Again, looking at comparables is another way to augment what you just said, Greg. Like if you look at comparables for Refinity, A rounds for companies that are IP heavy. They offer some sustainability benefit. I can't name them off the top of my head right now, but there's a handful of companies in the last 18 to 24 months that all have similar characteristics, but they generally did their A rounds at 100 to 200 million. So that ties in with what I was just talking about Refinity. If they got a 400 billion market cap and they have a certain penetration rate, there's a lot of heuristics you can do to triangulate, but you're going to come up with valuations that make sense that are not recognized today in the market because everybody's been focusing on our Excelsius story. They've completely ignored what else we have on our balance sheet.
Well, I'm going to go back and update my model because I think after this conversation, I'm convinced that I'm probably being a little bit too conservative. So I think we're kind of at the end of the outline that you and I had discussed for the call. Is there any other comments that you'd like to make before we open it up to Q&A?
Yeah, just the general statement. I think what's important to understand here, and I bring this up only because the market was very concerned about it last year. I mean, we went public with 47 million shares, and we're now up to 80 million shares. I mean, there's a lot of shares, but that's, again, not something that should ever be extrapolated going forward. If you look at the fact that our costs of going public have tapered off, we've dropped our G&A dramatically, we've shifted funding to the company level, the expectation going forward is de minimis amounts to grow this business. So people should focus on the
usually positive.
People should focus on the value. Yeah.
I mean, it's all kind of lining up. Why don't we open up to Q&A? Brent, if you can manage that, that'd be terrific because I really botched it last time.
Sure, Greg. So on the panel here, you can request if you'd like to join as a speaker. I'll bring people up and one by one, and Greg can facilitate the questions and answers. And, only guideline is be respectful, and you're welcome to join.
Anybody have a question?
I have a question.
Just approved.
Go ahead.
So my name is Andy. I had a question about the data cooling, and I was hoping maybe you could add some color on or walk us through what the typical sales cycle looks like. Specifically, when does the product get chosen? Do they wait till they have their GPUs installed? Is it purchased before they build out the center? How does that work?
Well, when you deliver is going to be different than when you book. I mean, what you're seeing in the industry right now is, and that's what we tried to say on the last earnings call, getting the commitments and the bookings is important, but when we deliver against those is going to be a function of when they need the cooling technology. If they can't get power, they're not going to order they're not going to order all the parts unless they know they've got power to operate the plant. But it's a very good question, but I'm going to ask that you defer that question to the CEO call because Josh can give a really better answer on the internal dynamics of how the order process works at Excelsius. So that's going to be on the 27th of April.
Okay,
Yeah.
Great. Thank you so much.
No problem.
For other questions, just please request to join.
I think Edward has a question.
Yep, just a minute. Let me bring him up.
Can you hear me?
Yes, we can hear you, Edward.
Great. Hi, Roland. Thanks for making time for this. I certainly agree that an investor day would be really helpful because I'm fairly new to the story, and it's hard to know what parameters or data points we have to measure the performance of these various management teams, relative to objectives that they have. That really doesn't come across on the quarterly calls. So just having more detail from those individual management teams, I think, would help investors get more comfortable with the story and how they're executing. But, there are a few things that I have. One is like this $50 million in bookings in Q1, which you said you hope that, the bulk of it will convert to revenue this year. So does that mean that the backlog that's prior to this year isn't going to, is there some difference in the more recent bookings that make them more real than the bookings that you have previously received?
In the previous quarter, we were talking about a gross pipeline that we're trying to convert into bookings, and we talked about us having a gross pipeline of $1 billion that we're actively pursuing. So greater than 50 million in bookings means we've converted part of that gross pipeline into actual orders. So
that's from your gross pipeline that you're now saying are real bookings.
They're translating into real bookings.
Revenue.
Yeah. That's exactly it. Yeah.
And then, so I'm trying to also get my hands around, the valuation, because if I say that Excelsius is worth $1 billion, let's say it's at a $100 million run rate at year end, and you've got 42% or 43% of it, so that gets you to, $5 a share or so, and then you add a few dollars for the other businesses based on, the valuations you are currently, that's as of today, let's say. But then, you've got your cash burn. So, you could argue that, fair value could be in the $5, $6 range, which is, significant upside from current price. But I don't think the people who are looking at this are looking at it to just, go from $4 to $5 or $6.
No, you're absolutely right. I mean, that's the correct way to look at it is you can say if you're buying the stock today and you believe in those valuations, you've got that much value already in it. So you've got some downside. You should have some theoretical downside protection in your price. All of those businesses are expected to grow. There's no doubt about that. All of those businesses are expected to grow. And they're expected to grow at a far greater rate than any money we're going to have to raise to fund that. And that goes back to a point we made earlier. If you look at how much we've spent, and the number is probably a little bit higher than when we first mentioned it, but we've spent about $170 million off of our balance sheet to create the companies we've created. And you look at the value we've created from that is enormously higher. It's north of 800 million, and with PureCycle we already distributed out 466 million in return to investors in the form of PureCycle shares. So that's an important metric to look at when you're saying, okay, well, companies trying to grow the value of its assets, but it also has to raise capital, and so the right metric to look at is what's the multiple on invested capital. Are they getting a very high multiple on invested capital? That's really the right way to look at it. Again, as I said earlier in the call, any young company that's growing is by definition going to have some dilution. You're going to have to fund to create that growth. That's axiomatic.
You're a lot like a biotech company, with a bunch of different things in various stages.
Well, different though, because biotech companies don't generally have a lot of recurring revenue. They have liquidity events when they hit on something big. Our goal is, again, to maintain majority ownership of our companies so that we can flow up cash flows. So companies get to cash flow positive, they build their operating surplus, but ultimately the consolidated cash flows are going to support the entire Innventure model, the creation of the new companies. So that's different than biotech. I think you might say we have characteristics of biotech today because we're OPEX heavier today, not because we're not generating free cash flow to the top today. But that's not a perpetual situation. The idea here is we're growing businesses with recurring cash flows, and those cash flows will ultimately stream up. And by
having the subs raise capital, they're getting better valuations than you are
Correct.
in the current marketplace, in your opinion.
Yeah, we're not getting the value on our balance sheet at all. So it makes no
Right,
sense to take.
But will you be diluted in those events? So over time, your percentage ownerships might decline slightly, and
Yeah, that's definitely the right way to look at it, because if we're not taking dilution on our balance sheet, we're taking in our share count, we're taking it somewhere else. But that's really what shareholders wanted to see. They say, look, we don't mind you taking the dilution over there because we really think Excelsius is a winner already, so we just don't want to dilute our ownership to that. And so we said, okay, well then the right way to do it is to shift the dilution to funding at the opco level.
yeah, I think that's right, especially, given what happens after you do some of these offerings. It's, and so will you still be able to consolidate all of these subsidiaries with your ownership levels and then have minority interest line items on your income statement, or how is it going to work?
Yeah, we'll be able to consolidate Excelsius and Refinity, which is the plan. We don't consolidate Aeroflex right now. Aeroflex is on the balance sheet because we don't have long-term voting control. We currently have voting control over Aeroflex because we manage a fund that has a significant stake in the business. But at some point in time, that'll get distributed out to the LPs of the fund. So we don't consolidate Aeroflex today. But with Refinity, first of all, with Excelsius, they'll start there. We don't see a need that we're going to have any dilution in our ownership in Excelsius because we believe that it's fully funded with its last raise. And in the case of Refinity, we own such a large amount. I think it's 68%. Yes. So there's a lot of room to take some dilution there. And we even own a higher percentage of the voting shares because all of the employee shares are non-voting. So we can take dilution at Refinity to fund its needs without having to worry about not being able to consolidate.
Okay, and I have two other questions if you have a minute. So,
sure, absolutely.
One is trying to connect the dots from where you are now to what has been said about 2028, where I think the comment was by mid-2028 you hope that the parent company would be cash flow positive or earnings generating.
Cash flow positive from operations, yeah.
So, I'm just trying to back in, because again, on the call, they don't talk about margins at Excelsius other than say that, they think they're generous or good margins. But, what's the revenue run rate? I mean, if you're exiting 2026 at $100 million run rate, are we talking about doubling revenues each year as hopeful, or is that too conservative? Is it too aggressive? Because, I'm just trying to get to what revenue run rate you need to get to break even by mid-2028, which is, over 2 years from now.
Well, I'm going to answer a little bit anecdotally. I mean, I don't have the number off the top of my head, so you might have to verify this and look it up. But I look at the 𝙘𝙤𝙤 acquisition. They're in single-phase water, and single-phase water has a very small penetration already of liquid cooling. So and so they're already valued, at a very high number. So if you look at what they're doing in single phase water, and they're I can't remember what they are, $500 million in revenue. We can just do the math backwards. They were bought at 9 times.
Yeah. 270.
Yeah, they were at $270 million in that was 23 though, I think. Yeah, we're looking at an older number.
I've done the math. I think they exited last year at around 130 million, and I think they were projecting to do, or somewhere around 300 million this year. So one could argue that if Excelsius was simply to double and you were to put a 10x multiple on revenue, realistically, one could argue that Excelsius could be, if that in fact was the case, $2 billion plus market cap exiting the year.
Yeah, I mean, again, I'm not going to put numbers on it, but we don't expect our growth rate to be linear in the first few years. We expect it to be more exponential.
So throughout this year, should we expect to see the backlog, to kind of measure the success of the operating companies? I mean, should we expect to see more positive news on backlog each quarter, or is it going to be very lumpy from quarter to quarter?
I mean, I think the right way to measure it is to measure the trend of the backlog, or of the gross pipeline, and then the backlog, the bookings.
Okay, and then my other question is, so you've met with institutional investors, and I haven't seen a lot of filings on the company. Is it that the market cap is really small, and that's maybe what's limiting bringing in a lot of institutional investors into the story, or maybe they're just buying very small stakes and they don't show up? What kind of feedback, if you want to share, have you had with institutional investors you've met with?
Yeah, no, the institutional investor was increased dramatically. I think we went from 40 to 100 or 101 institutional investors in Q4, and we know that's gone up in Q1. Going from adding 64 new institutional positions in Q4 was significant, and of course, when we did the round at with Titan, the registered direct offering, it brought in exclusively institutional investors. So that's quite significant. So right now, our percentage ownership of institutional percentage ownership is around 30%. Yes. So it's quite significant, and that's actually quite important, because what you're really seeing. And that's the whole concept of base building. When you look at a stock that kind of consolidates in the range, we've been consolidating, you got sellers, you got buyers, you're turning the float over and you're putting it into very strong hands. You're putting it in.
That's what I'm trying to get at.
Yeah.
Because it doesn't, it trades kind of weird, I mean, I'm not that involved in small cap companies and everything, but it just seems to really move, and I get it after the offering, did you have a convert back in January also as part of that, or no? I forget.
No, that was a straight equity offering.
And you had good news and the stock, kind of tanked for a while, and slowly recovered. And that was even with the good news about the upsize offering with JCI and Legrand.
Yeah, sorry, I was just going to say, I think the reason for that is because people couldn't project how much more we'd need to raise. People were penalizing us to say, we keep diluting, we keep raising money, even though the values are growing. So they were starting to price it at a discount to our value. We weren't getting fair value. They were valuing us like a biotech or like a like a public venture studio that has minority positions but no control over its businesses, and that's the incorrect framing of it. And so we tried to correct that narrative throughout the quarter, which I think we did. But yeah, I mean, look, we can get the data out to you because it's public information. Like, you can go to S&P Capital IQ. We get reports from NASDAQ. We kind of know what the makeup of the portfolio looks like. We're about 30% institutions, about 101 holders. We're about 20% individuals, insiders. VC PE is about 5%, corps are about 0.94, public and other is about 43%. And then if we look at the institutional by type, you've got traditional investment managers are about 50%. So long-only investment managers are about 50% of the institutional ownership. Family offices and trusts are about 23%. Hedge fund is about 22. Pensions are small. We got 3 pension holders, but about 0.06%. But that's and I'm talking Q4. In Q1 that only increased.
Yeah, I would think at some point, some of the volatility would dry up, and it would, once these shares are all placed and, some of the sellers are out of the way.
Well, when you're turning over your float, that's really when you look at technical perspectives, that's really when you see stocks consolidate. You go to the bottom of the range, you go to the top of the range, they kind of float around in there. And once you've turned over that float and overhang, and then you have real news driving the stock, that's kind of when one would expect that, you have the potential to have a breakout.
Right. Well, I appreciate you, participating on the spaces. Thanks very much.
No, I appreciate your questions as well. Thanks so much as well. Yeah.
Thanks, Edward.
Yeah.
Any other questions? All right, well, we have one from Zach. Hey, Zach, how are you? Zach, can you hear me?
Yep.
Zach, I can hear you now.
All right. Thanks for doing this, Greg.
Yeah, my pleasure.
Roland, good to talk to you again. I think it'd be important for everyone if you would just briefly talk about, JCI and Legrand, of how you guys kind of sought them out as more investors versus it wasn't just going to the market and, getting the highest bid, and maybe just a little bit about how you see that partnership going.
Yeah. So no, I mean, it was, I think we can, yeah. So no, I mean, we engaged an investment bank for that process to find the strategic investors, and what we were looking for were strategics that made sense to grow the pie that we could unlock. There were no shortage of strategics that were interested. Josh Clayman was the one that made the decisions as to which strategics made most sense for him. Some were rejected, and some were allowed in. So again, it was very, very strategic. But this was a Goldman-led round. It was a process that went on for a number of months, about half a year, I think, in total. JCI came in first. And then we had a number of other strategics that were there. At the end of the day, it made sense just to focus on JCI and add Legrand. So JCI added to their investment when Legrand came in. And again, it goes back to kind of what I was referring to earlier. They all operate in different spaces. They're already critical infrastructure providers, but they complement each other such that they can go and offer total solutions to the market together. So again, it was pretty evenly split. I mean, JC had a little bit more. They were 35. They did 25 initially, and then another 10, and then Legrand came in with 30. But I think you'll be able, Zach, to get a lot more information about why it's strategic when Josh speaks on the 27th.
Yep. Thank you.
Okay.
All right, any other questions? All right, well, with that, I think Edward and Zach asked questions for many of us, and we've got one more, C-Rick.
Oh yeah, one question over here. Is JCI? I mean, this question is directed at the Excelsius part of the company, but is JCI involved in kind of getting the Excelsius product in specifications and within project documents for data centers?
Yeah, that's going to be a question for the CEO call. Yeah. It's a good question, but again, I can't answer it directly other than to say it's a strategic investment. So you would imagine that they would be collaborating and doing things together. So, but I think that's a good question to ask Josh if you're going to be on the CEO call on the 27th.
Yeah, it's just one comment. I did see Excelsius reference in a JCI deck that certainly had the implication that was their plan, but I think we are all kind of on pins and needles waiting to hear what Josh is able to share with us on the 27th.
It's one of the things, just a comment from my side, it's one of the things that I'm most excited about, because one would imagine that Legrand and JCI have very significant pipelines that are already in various stages of the sales cycle, and they have the opportunity to bring Celsius to the table and really, bring them up to the 2-yard line instead of, starting a sales cycle from, point of just trying to make an introduction. So I think that's a huge value to the company that's not truly reflected in the share price. I know, Roland, you may not want to comment too much more on that until the CEO call, but that's one thing I'm personally very excited about.
Yeah, I mean, look, you summed it up right. I have one way to characterize it. JCI and Legrand investing, that's market leader validation. I think that it kind of speaks for itself. Them making a call on Excelsius is saying something from the leaders in the marketplace already.
Yeah, it would be great if it was part of their product portfolio and they started bidding, but
Yep.
that's a logical inference that we don't yet have ground truth on.
Correct. Yeah. But I think you'll find a lot of that. I think you're going to find a lot of that, Greg, as we get into the CEO call.
Got it. Yeah. So more to come.
Always more to come when you're a young and growing company, Greg. So,
Yep.
we hope it's going to be exciting. And again, it's not just Excelsius. It's don't forget about Aeroflex and Refinity. There's real value. They have enormous TAMs.
Yep. I'm certainly going to be there on the 27th, and I'm eager to learn more and hopefully be able to ask a few questions of my own.
I appreciate it. And I appreciate, Greg, you hosting me again on here, and look forward to doing it again.
Yeah, no, thanks for making the time. I know there are a lot of folks that are very interested in the story and very interested in the potential to see some significant re-rating as the story continues to congeal. So appreciate your time. Bryn, thanks for helping me with the co-hosting, and hopefully everybody stays safe out there and is successful with their investment endeavors.
Great. Well, thanks again, Greg, and
Thank you all.
special shout out to Dave Ďábľanovský, our CFO. It's his birthday today, so happy birthday, Dave. Yeah.
Oh, thanks, Roland.
Hey, happy birthday, Dave.
Hey, thanks. Thanks,
All right,
everyone
take
on
care,
the
guys.
call. Appreciate it.
All right. Thanks, guys.
Thank you.
Now you're
Are we clear?